Good evening to everybody. It's with great pleasure to see you in this new academic debate organized by the European Banking Institute. Our topic is a very challenging one. It's on the European securitization market and the effects of an uneven regulatory playing field. And it is with great pleasure that my dear colleague, Bart Joosen, the former president of the academic board of the EBI, and dear friend and colleague in the EBI and in general in academia, will preside over the panel with two distinguished speakers, which Bart, you will introduce. I will stay silent, and if necessary, I will intervene. So thank you very much for having accepted to chair this event, dear Bart, and I give you immediately the floor. Thank you.
Thank you ever so much, dear Christos, for your kind introduction. Indeed, an important academic debate today on the securitization markets. Today we have the pleasure basically to have the debate held by two distinguished scholarly researchers on the very topic. Let me just first introduce them to you and then explain the proceedings of this academic debate. So, first of all, Thomas Papadogiannis, and he is an assistant professor in commercial law at the University of Nottingham. His research focuses on financial law and financial regulation, with a particular interest in debt financing and the ways in which regulation and policy interact with and shape the debt markets in Europe. Secondly, we have the sincere pleasure to have Vincenzo Bavoso, and he's a senior lecturer in commercial law in the Law School University of Manchester, and his research interests embrace two main strands. Firstly, the broad field of financial regulation, and in particular the regulation and practice of capital markets. Secondly, the intersection between corporate law and governance. He has published widely in the above areas. His work on securitization and capital markets has been cited by, amongst others, the EU Parliament, Wall Street Journal, Bloomberg, and S&P Global Markets. His work on the EU Capital Markets Union, which will be an important topic, and on the attendant STS securitization regulation, have informed policy-making exercises, among which the Foundation for European Progressive Studies and the Center for European Policy Studies. Today we will have a debate, a true debate, where the two present scholars will each present their own view, and to anticipate already a little bit on the debate, these views are quite opposing. The first speaker will speak about the securitization regulation as introduced in 2019, and pleas for a certain form of deregulation. The second speaker will take the contrary position and will explain in which way the securitization regulation, as it has been introduced, serves its purposes and the rationale for strict regulation of the securitization markets. The proceedings will be as follows. Thomas Papadogiannis will first speak, supported by slides which are now on your screen. Hopefully that you can see that. If not, please do let us know in the chat box, and then we can fix that. And after that, Vincenzo Bavoso will take over, will hold, again, guided by the slides, his introduction. After that, basically, we will invite Thomas, basically, to reflect a little bit on the comments made by Vincenzo, and the other way around. And then we would like to invite all of you attending participants, please be using the chat function of this system to raise your questions. It is my responsibility to keep an eye on the chat box, see which questions are flowing in, and then I will make sure that they are posed to either Thomas or Vincenzo, depending on the nature of the question. With that, we hope to have a lively academic debate. If everything runs well, we aim to end this academic debate at 6 o'clock CET, so that will be 7 o'clock Athens and 5 o'clock UK. So that's basically the plan. So having introduced that to you as participants, I now kindly invite Thomas to the floor for his presentation.
Thank you very much for this very kind introduction. And thank you, everyone, for taking the time to attend this event tonight, which is very kindly sponsored by the EBI. So I would like to thank, first of all, Professor Gortsos, Professor Joosen, and everybody else from the Institute who was involved in making this event a reality. And of course, many thanks to Vincenzo, my co-discussant, who agreed to participate in this debate. Thank you all very much. I do hope that you will find this debate about securitization and its regulation as stimulating as we do, and I very much look forward to hearing your thoughts and comments. Now, I would like to mention that this presentation of mine tonight is based on a research project in which I was involved last year, which was very kindly sponsored by the EBI and True Sale International, TSI. So I'm very honored to be able to be here tonight and present to the EBI the results of that research that I conducted with their precious help. So, by way of introduction, tonight I will be debating for, if you will, the deregulation of the European securitization market. Now, I think it would make sense to give you some context. What do we mean when we say securitization? Well, in very plain terms, we use the term securitization to describe the technique through which a financial institution like a bank can repackage the assets it has on its balance sheet, for example, its mortgage loans, and it can remove them from its balance sheet by selling them to an independent third party, an SPV or a specialized purpose vehicle, and it can raise funds by issuing debt securities like bonds to investors. You can see here on this diagram a very simple securitization structure, a residential mortgage-backed security, or RMBS for short, which shows exactly what I've been talking about. So we have a bank that has mortgage loans on its balance sheet, it sells them to the SPV, removes them that way from the balance sheet, and then the SPV issues bonds that are collateralized or backed by those residential loans. Okay, so maybe or probably some of you will remember securitization from the global financial crisis, when, according to the conventional narrative at least, banks, primarily in the US, would give subprime mortgage loans, as they were called, to people who could not really afford them, and then they would shift the risk stemming from those subprime loans to other market participants like European banks or European pension funds, etc. And once it became clear that those subprime mortgage loans were not worth what people thought they were worth, and so the bonds that had been bought by the other market participants were also worthless, panic ensued, to put it very simply. Investors suffered massive losses, and that triggered what came to be known as the global financial crisis of 2007-2009. Now, in the aftermath of the crisis, we have a very strict regulatory framework that is introduced in Europe, which treats securitization as something very problematic, so it treats it punitively. As a result of that framework, at least in my opinion, the European securitization market that was once vibrant becomes a shadow of its former self, a fraction of what it once was. This punitive framework, as Professor Joosen mentioned earlier, is replaced in 2019 by a new framework, which is, at least in theory, more accepting. So it tries to rehabilitate, if you will, securitization, and it tries to help the European securitization markets to grow once again. That's the wider context that I think is useful for our presentation and for the wider debate tonight. Now, my point in this presentation is not that we need to dismantle this new accepting framework in its entirety. Such a radical approach, after all, would be not just infeasible, but also not advisable, in my view. The memories of the global financial crisis and the role of securitization, I think, are a sufficient cautionary tale of what would happen if we leave too much faith, if we put too much faith in the ability of the market to regulate itself. Rather, the point I will make tonight is that even under this supposedly accepting framework that we have, there still exists in Europe what I call an uneven regulatory playing field for securitization. This is evident when the regulatory framework for securitization in Europe is compared to the framework that applies to other financial instruments that can be considered neighboring or comparable to securitization, like corporate bonds or covered bonds. To put it very simply, securitization in Europe is still being treated adversely compared to the treatment that those other financial instruments receive. And as a result of that adverse treatment, the European securitization market is still unable to escape from the subdued state it has been ever since the crisis, so 15 years ago. But as the regulator itself accepts, if allowed to develop once again, securitization in Europe can and should play a big role in achieving the objectives of the Capital Markets Union, the CMU, among which is the reduction of the dependence of the European economy on its banking sector. So what I will be arguing tonight is that by adopting a more lenient approach, a more linear regulatory approach, or by deregulating securitization, if you want to use this kind of terminology, the European regulator can help the European securitization market, but even more importantly, the entire European economy to develop once again. To give you a little roadmap of my presentation, I will start by explaining, without much technical detail, I promise, the adverse treatment that securitization currently receives in Europe. And in that context, it is worth noting that this is something that the European securitization industry has been very vocal about. They have constantly flagged it as a problem, this adverse treatment of securitization, and they have called for a recalibration of the existing framework that would help level the playing field. Having done that, I will then proceed on the basis that the playing field is leveled in Europe to assess the effects of this leveling on the European securitization market. I will do that by examining whether there exists a competitive relationship between specific securitization structures and those other neighboring instruments that I mentioned earlier, for example, covered bonds and corporate bonds. The point is, if there is such a competitive relationship, then a level playing field could help market participants, it could incentivize market participants to switch to securitization instead of those other financial instruments. That's the point that I'm trying to make. This way, the European securitization market would flourish, and along with it, the wider European economy. That's my wider point. And finally, I will assess the prospects of such a leveling of the playing field taking place in the foreseeable future by commenting on the European regulator's response to the concerns of the industry. The point is to see whether the regulator agrees that there is an uneven playing field, and if so, whether a leveling of the playing field is warranted in its view. Right. So, beginning with the specific regulatory areas in which the securitization in Europe receives an adverse treatment, so there is an adverse or uneven regulatory playing field according to the industry, those are first, disclosure and due diligence obligations imposed on investors and issuers under the securitization regulation, the SCCR. Second, we have capital requirements under the capital requirements regulation, the CRR, when banks invest in securitization. Then we have the inclusion of assets in the liquidity portfolios that banks have to hold under the LCR, the liquidity coverage ratio. And finally, we have the capital requirements under Solvency II when insurers invest in securitization. If we look at the provisions that apply for securitization and we compare them to the provisions that apply to those other financial instruments that I mentioned earlier, such as corporate bonds or covered bonds, we'll see that securitization is indeed treated adversely in all those regulatory areas that I just mentioned. Now, let me give you just a couple of very simple examples to make my point clear. Regarding disclosure and due diligence obligations, for example, the SCCR imposes disclosure obligations on issuers that are considered not just disproportionate, but also unfit for purpose by the industry. At the same time, by forcing investors to include in their due diligence all the information that is disclosed by the issuer, the European regulator creates an unnecessary and costly burden for securitization and actually risks diluting the information that is actually critical for due diligence purposes. Under the Covered Bond Directive, on the other hand, issuers are only required to disclose a fraction of the information that needs to be disclosed to securitization investors, whereas covered bond investors are under no obligation to conduct any due diligence whatsoever under the Covered Bond Directive. So it is clear, at least in my view, that the existing framework incentivizes market participants to engage in covered bond transactions by making it relatively easy and simple to sell and buy covered bonds. When it comes to securitization, on the other hand, engaging in a transaction is both costly and complex. So the message seems to be stay away from it. To give you an additional quick example regarding the liquidity coverage ratio, again, securitization is treated adversely. Securitization tranches can only be included in the lowest level of the LCR. And even then, they are subject to very stringent requirements regarding maturity caps and haircuts and credit rating limits. Corporate bonds and covered bonds of the same maturity and of the same rating can be included in the higher levels of the LCR. So again, the message to European banks by the European regulator seems to be, for liquidity, you should focus on corporate bonds and covered bonds, and you should stay away from securitization. So based on this analysis, I would argue that the securitization industry in Europe is correct to be complaining that there is an uneven regulatory playing field for securitization. So far, so good. But what does that mean? Why does it matter for the wider European economy that the regulator creates disincentives for engaging in securitization transactions? And what could realistically be achieved if we had a more level playing field? How would that help the European economy to grow? As I mentioned earlier, it is my view that a leveling of the regulatory playing field could indeed revive the European securitization market and the wider European economy, but only if there is a direct competitive relationship between specific securitization structures and other neighboring financial instruments. Because if there is such a competitive relationship, then a level playing field would incentivize market participants to leave the covered bond market or to leave the corporate bond market and switch to the securitization market. Otherwise, if there is no such competitive relationship, then a level playing field wouldn't help much. We would be comparing apples to oranges. In my opinion, such a direct competitive relationship does exist between, on the one hand, residential mortgage-backed securities, RMBS for short. Remember the diagram I showed you earlier, which depicted an RMBS transaction. And on the other hand, covered bonds that are backed by residential mortgage loans. This competitive relationship between RMBS and covered bonds is confirmed by existing academic literature, and it's also corroborated by empirical findings, according to which, during the global financial crisis of 2007-2009, covered bonds were observed to substitute or crowd out RMBS, in the sense that credit institutions that had a covered bond program were observed to securitize less of their assets. And at the same time, a migration of investors away from RMBS and towards covered bonds was also observed during that time. This substitution during the global financial crisis was possible for a number of reasons, mainly because both RMBS and covered bonds are used by banks to finance their residential mortgage loan business. There's also overlap in the assets that collateralize both RMBS and covered bonds, which are mainly in Europe, high-quality residential mortgage loans. And finally, there is overlap in the investor basis of the two financial instruments, because banks and funds form the bulk of both investor bases. Those are the reasons why there was such a crowding out. What is interesting to note is that when market commentators try to figure out why RMBS was substituted by covered bonds, a lot of them also talk about regulation, and specifically the fact that even back then, covered bonds were being treated favorably compared to RMBS. So in other words, it seems like it was the preferential regulatory treatment that covered bonds were receiving at the time that can be blamed, at least partially, for this crowding out. Could it be argued that the same thing is happening today? I think that's the important question. Is RMBS still being crowded out by covered bonds? And if so, is it something that the regulatory framework that we have is to blame? By examining market data from the post-GFC period until today, we can see that the European RMBS market is in a state of contraction, whereas the European covered bond market is in a state of expansion, which is the exact same dynamic that existed during the GFC when RMBS was being substituted by covered bonds. You can see here on this slide some data about annual issuance that so very briefly, in the post-GFC period, average annual RMBS issuance is roughly 25% of average annual covered bond issuance. If we'll go back to the GFC period, that average issuance was 58% when RMBS is covered to covered bonds. This signifies that the gap between the European RMBS market and the European covered bond market has increased, at least in terms of average annual issuance. The same conclusion can be reached when we compare outstanding amounts in the two markets. Because in the period between 2013 and 2022, the European covered bond market grew exponentially from roughly 2.2 trillions in 2013 to 2.4 trillions in 2022. The RMBS market, on the other hand, contracted from 880 billion euros in 2013 to 530 billion euros in 2022. So, to recap, there is a clear parallel, at least in my view, between the global financial crisis period and today. This parallel, coupled with the clear and relationship between RMBS and covered bonds, means, I believe, that the European securitization industry is correct to be calling for a leveling of the playing field. Because by treating RMBS more favorably, the European regulator can incentivize market participants to switch to RMBS instead of covered bonds. Even more importantly, the significance of the RMBS segment for the wider European securitization market means that by helping RMBS, the European regulator can help the entire European securitization market to grow once again. And if freed from its restrictions, the European securitization market can help the European economy to grow by functioning as a bridge between the real economy, that is, individuals and businesses who are in need of funds, and the capital markets that can be accessed through securitization. That way, the dependence of the European economy on its banking sector would become less intense, just like the regulator intends to become. So it is worth asking, if this is the goal and if this is feasible, is the regulator working towards this goal? Is the regulator trying to accelerate securitization? And are they trying to help the real economy to access the capital markets through securitization? To be honest, if we want to be realistic, we would say not really, at least for the time being. Because the regulator does recognize that Europe needs securitization if the CMU is to become a success and if our economy is to become less dependent on its banking sector. But at the same time, the regulator seems to be turning a blind eye on the effects that its treatment of securitization is having on the market and on the wider European economy. The first thing that we need to note is that the regulator does not agree that there is an adverse treatment or that there is an uneven playing field for securitization, at least to an extent that this should be a source of concern. Because as the regulator is arguing, securitization should be treated most adversely because it is more risky than other financial instruments like covered bonds. And in any event, the adverse treatment that securitization receives is not the main reason, at least according to the regulator, why market participants are not interested in the technique. Instead, the regulator argues that market participants are more interested in other financial instruments because they are more suitable to their investment profile. They offer more yield, They have a better marketability, they have a better liquidity, etc. So it's not a matter of the adverse treatment that securitization receives. For those reasons, the European regulator has expressed no interest in engaging in any fundamental recalibration of the existing framework, as the industry is calling for, which would help level the playing field. There is a suggestion that a technical fine-tuning of the existing framework might take place in the foreseeable future, and this could help level the playing field in some ways, at least indirectly. To give you some very quick examples, the Commission has mandated ESMA to streamline disclosure obligations for issuers and develop separate templates for private securitization deals. And there are also suggestions by the ESAs and the European Parliament to reduce capital requirements for certain senior securitization tranches that are retained by originating institutions. So in that way, if those amendments do take place, a leveling of the playing field could be achieved to an extent. But in all other respects, regarding due diligence and liquidity and solvency too, there is no intention on behalf of the regulator to engage in any fundamental recalibration. So the framework will remain uneven against securitization. So to conclude, in my presentation, I have tried to show that securitization receives an adverse treatment in Europe, and that this adverse treatment prevents the market from developing and functions as a roadblock to the achievement of the objectives of the CMU. And I have also tried to show that despite recognizing its importance for Europe, the European regulator still treats securitization as something irrelevant at best or as something dangerous at worst. This brings us to the end of my presentation. Thank you for bearing with me, and I hope you enjoyed it. I look forward to hearing your thoughts and comments, and of course, Vincenzo's views. So, Vincenzo, the floor is yours. Thank you.
Thank you very much, Thomas. If you can stop sharing, and then the screen is for Vincenzo.
I'll just share mine then. Thank you so much. You see it all right? Right. Thank you so much for the very kind invitation. Thank you for bringing me into this great debate. Obviously, I look forward to your views, to everyone's views. Thank you, Thomas, for the very clear presentation and for paving the way to what I'm going to say. So I'll just crack on so we have time for the rest, and I'll try my best to be timely, of course. Now, as you anticipated, I take a view that, so first of all, I partly agree with Thomas's presentation. And I do agree that we do have an uneven playing field here. Where we probably slightly disagree is that my presentation takes the view that the uneven playing field that we have between the regulation of securitization and the regulation of other products is necessary. And I will explain why in the following. The only thing is that I don't seem to be able to change. Oh, yeah. Yes. Changing now. Yeah, sorry. Now, I will provide some background, and I will also, I will not repeat what Thomas said about the fundamental transactional structure of securitization, because I agree with everything that Thomas very clearly said there. So just a couple of things on the background. The securitization market reached a standstill after the global financial crisis. And this was more severe in the European Union. And let's remember that the UK was part of the European Union at that time than in the US. Now, the reason for that reaction was obviously to be found in several factors. Market bias is probably the most important factor. And let's remember the policy responses that ensued the global financial crisis of 2008. The Turner Review in the UK, partly the Larosière report at the European Union level, the Global Financial Crisis Inquiry Commission in the US. All these pointed quite clearly at financial innovation in the structured credit market as a fundamental reason that led to the crisis of 2008. And obviously, the regulatory adjustments that were incoming and eventually were implemented which made structured finance and securitization more squarely more costly, both for banks and securitizing and for investors buying structured products. Now, a very similar phenomenon can be observed in the US, but where the US changed from compared to Europe is that in the US after 2008, we have a stronger involvement of the government in actually backing up some transactions. And if you look at charts of securitization in the US after the crisis, you see that securitization remains alive in government-sponsored shapes, but effectively you don't see any of the innovations that we saw before the crisis, such as CDOs, synthetic, squared, and so on. So effectively, if you look, we have a situation akin to what we had decades earlier with the government-sponsored transactions. Still not able, sorry, it's, I'm not able to change pages. Let me just, okay. So what actions were taken after the crisis? Obviously, the trend starts changing in the middle of the decade, around 2014, 2015. Actions are taken firstly by the Bank of England and the ECB in 2014 with a number of policy papers. As Thomas mentioned, these policy papers really look at the role of securitization in one, fostering EU-wide European capital markets, so integrated, harmonized capital markets centered on securitization, and secondly, to ensure a wider economic recovery after the global financial crisis. Eventually, these policy papers flowed into the proposal for a regulation and in the regulation for securitization, and in particular into the STS framework. So this idea of reviving securitization was centered effectively into a two-phase regulation. One of securitization as a whole, and the second key element was to create a label which at the European level we call simple, transparent, and standardized. Outside of that, under the IOSCO and Basel label is called STC, simple, transparent, and comparable. Well, transactions complying with this label would attract a better prudential treatment. Obviously, securitization is still possible outside of compliance with this label, but obviously it would attract a higher, more costly prudential treatment. Basically, reflecting exactly what Thomas presented very clearly. These criteria, or rather compliance with these criteria, essentially would put securitization, as one commentator aptly pointed out, in the fashion in which it was practiced back in the 1980s or early 1990s. Essentially, a transaction that would be streamlined, simplified, creating therefore a level of transparency that would enable investors to access the level of riskiness of the structured product and the underlying assets. Okay, so simple, transparent, and standardized. Effectively, what that means is that most of the pre-crisis innovation would be excluded from this framework. So you would still be able to conduct securitization, as was the case before the crisis, but that type of securitization would not comply with the STS criteria, and therefore it would attract higher level of capital, the liquidity framework, the disclosure obligations, and so on. From the outset, and when I say from the outset, I mean from the early proposal of the regulation, before the regulation was enshrined in its final draft, this attracted some criticism. The main criticism behind the STS framework and the regulation as a whole was the lack of clarity on some key criteria, and particularly the simplicity and standardization, which in fact did change in the final draft that became regulation. And in particular, criticism was directed at the idea of synthetics. The earlier draft of the securitization regulation essentially prohibited from the STS, excluded from the STS synthetics as a whole, because essentially to qualify for the STS, you needed a true sale. I did follow at that time the consultation process, and it was clear that the banking stakeholder group thought that in order to lend to the real economy, especially to SMEs, a degree of some synthetics were necessary. So it's a question of transaction cost and a question of effectiveness, or if you want to put it that way, market efficiency. So essentially, securitization went back into the framework by introducing a distinction between balance sheet synthetics and arbitrage synthetics. No time to go into the details of these distinctions, but essentially balance sheet synthetics were introduced into the framework by the design of a specific regime mirroring the three criteria, whereas arbitrage synthetics are essentially prohibited. The initial critique of the regulation did not only hinge on this ambivalent position on synthetics, but on a wider issue on the ambivalence of simplicity as a whole. The Basel paper, for instance, stated years ago that there's nothing simple per se in securitization, even if it's plain vanilla form, transactional form. For instance, the Commission never took a stance on the question of tranching. And we know that tranching is one of the transactional structure of securitization that creates interconnectedness, it fosters interconnectedness, complexity, and other issues that I'm going to discuss a little bit more in the next couple of slides. Overall, critiques towards the STS framework was hinging on the loose definition of simplicity, the unaddressed interlinks that securitization creates with the shadow banking system, and the question of not regulating those interconnectedness, which is now becoming a separate issue because we are seeing a plethora of policy papers dealing with non-bank financial intermediation and the links between banks and non-banks. Well, non-banking and shadow banking is effectively the same thing. And then lastly, but not least, is the supervisory framework within which this securitization regulation and the wider capital markets union operates. So a bit of discussion on that. As Thomas clearly pointed out, and data confirms that, the securitization market has not taken off as some participants, some commentators were hoping. And I, for one, even though I've been critical of regulation, I've been critical of some aspects of the CMU, I would have expected the market to restart to a greater extent. So in particular, I think there is a failure of the STS to attract more transactions, more market participants. However, the market has restarted. Financial innovation has restarted. We've had securitization of P2P loans. We've got structured finance involving digital assets. We've had transactions involving high leverage loans, even though that's CLO, which is not a structure that is completely akin to securitization. It's a slightly different transactional structure, which does not comply with STS criteria, even though some market participants would want that to be involved into the STS framework. We have new processes such as CLOs, as I mentioned, but also significant risk transfer securitization, which has been employed heavily by banks. Now, the question is this. In some cases, risks remain opaque, particularly in some of these newly innovated transactional structures. And that is because of the underlying difficulty to assess the underlying assets, as is the case, for instance, with P2P loans or with high leverage loans. Fundamental question here is that the legal technology of securitization remains at the very heart of repackaging financial flows of intrinsically risky and opaque nature. It doesn't mean that all securitization involve those types of risky and opaque transactional flows, but the legal technology of securitization lends itself to transform transactional flows, financial flows. And the fact that the regulation includes a preferential regime for those who comply with specific criteria should alert in principle on the possibility of using that regime for regulatory arbitrage purposes. Okay, and while this so far hasn't happened for a variety of reasons that include also market fragmentation and the lack of clarity of the supervisory structure, the fact that we have two different regimes should be an alert for us, should be a red flag. And this particularly given the still uncertain supervisory structure within which CMU operates, with huge reliance, for instance, on market participants for specific inputs, such as, for instance, the notification process. So what I'm suggesting here is that I would have expected that the STS, I would have expected the STS to attract a higher volume of transactions. But I am justifying, notwithstanding that lower volume of transactions, I'm justifying the, I would have justified even a stricter regulatory framework, especially for the STS. And these are some of the reasons why I think the uneven playing field is necessary. I'll just go through these points and I will add something in the final slides. So firstly, it's a question of transactional complexity that has been associated with the capacity of securitization to transform high-risk assets into liquid and tradable bonds. Okay, this is intrinsic with securitization. It's great when the cycle is positive and when the economic outlook is good, but this becomes a problem when the financial cycle turns and the securitized bonds, wherever they are, lose liquidity. This was very much at the heart of the dynamics of 2008, but history has already repeated itself. This was also at the heart of the 2020 panic, when CLO completely lost value. And if it hadn't been for the infusion of liquidity of all the central banks, the ECB, the Bank of England, and the Fed, we would have already witnessed a massive default in that market. The second aspect, the second justification, is the off-balance sheet nature of securitization, which naturally fosters interconnectedness between banks and non-banks, or shadow banks, if you want, and specifically with the repo market, another area that has remained only marginally regulated, not just at the European level, I would say. Thirdly, securitization in itself, especially with the pre-crisis innovations, some of which, like tranching, have remained unaddressed, has traditionally attracted, particularly over the last couple of decades, investors that participate in capital markets with pro-cyclical attitudes to risk-taking, due to a number of factors such as tranching, risk mitigation techniques such as derivatives, and via the reliance on credit ratings. When you have tranching, it's easier to rely on a specific credit rating that is attached to a specific tranche. Other capital markets instruments have traditionally been associated with much less pro-cyclical investment patterns. And lastly, summing up these motives, securitization has the capacity to essentially create systemic risk. So there is not only a question of default rate and product success in its sets, but it's the capacity of the transaction in itself and the product to create systemic risk, the transactional features, so the off-balance sheet character, the complexity, the involvement of so many market participants across different markets, and the potential to be a key driver of financial cycles. So effectively, what I'm saying here is that if you read Minsky, who is the main authority on financial cycles, on leverage cycles, if you read Minsky, Minsky doesn't refer to securitization because back in the days, it wasn't such a big thing. When Minsky discusses financial transformation on banks' balance sheet, he is referring essentially to the effect of what securitization does. So why I justify the uneven playing field? So essentially, I disagree with the regulator here. I think there is an uneven playing field, but unlike the regulator, I think it's necessary. It's necessary because essentially a more favorable prudential treatment that is afforded to other market instruments, such as covered bonds, needs to be seen in light of the transactional features of these other products. So, for instance, if you look at covered bonds, and my understanding, having read Thomas' paper, is that that's the main comparison there. I'm not sure we have a competition there. I'm not sure about the word of the use of the word competing products. Essentially, covered bonds are less prone to systemic risk creation. They are on balance sheet, so they don't create capital relief for the banks that resort to covered bonds, and their rating is much more straightforward. So even the reliance on credit rating leads to much fewer problems. So my presentation doesn't deny that we have an uneven playing field. It suggests that it's the result of a functional approach to very different segments of capital markets, that achieve different goals, whereby securitization, in my view, is rightly considered more risky by design. And what I also stress at the end is that even in the earlier stage of the proposal for a regulation, there were some market respondents that were advocating a tighter approach to the regulation of securitization. One example, for instance, is the French regulator that advocated a tighter definition of simplicity and also a tighter definition of standardization. And I will stop here. Again, if my last slides doesn't come up, thank you so much. Look forward to the questions and to the discussion. Thank you so much.
Thank you very much, Vincenzo. So we agreed that both Thomas and yourself would have, let's say, 2 minutes to give very brief comments, staccato style, please, and then have a bit of an exchange. The first questions are flowing in. I have a couple of questions myself, so and then maybe we can have a bit of a debate the last 10 minutes of this session. So, Thomas, 2 minutes of staccato comments.
Thank you very much, Professor Joosen, and thank you, Vincenzo, for that presentation of yours. It's great that we can disagree in a civilized and polite manner. Now, on general, however, I don't disagree with the points you made. Indeed, securitization can be many things, and saying that securitization across the board should be treated in a more lenient regulatory way is at least debatable. I wouldn't necessarily go down that road, because when you say securitization, you might mean RMBS, or you might mean CLO, you might mean a true sale, vanilla, as you said, transaction, or you might mean an arbitrage synthetic. So I wouldn't suggest that all types of securitization should be treated the same way. What I tried to do in my presentation is to focus on that specific structure that I consider neighboring or comparable to covered bonds or mortgage covered bonds, which is residential mortgage-backed securities, which are usually true sale, so they don't involve a synthetic structure. And so far as the other concerns, or at least some of the concerns you mentioned, I'm not sure whether they apply 100% to RMBS. For instance, the issue of complexity or transactional complexity, yes, we do still have tranching, but I think that otherwise RMBS is much simpler than a CLO, for instance. And even when it comes to tranching, I can see why slicing the issue in multiple tranches, as you said, in multiple parts, can be more complex than a single tranche transaction like a covered bond. But at the same time, tranching is a credit enhancement mechanism. And credit enhancement means that risks for those who take advantage of tranching are reduced. So for senior RMBS investors, because of tranching, the risks they face are reduced. So I'm not sure if tranching is necessarily problematic, although I can see your point. So far as the liquidity point is concerned, I completely understand what you say. At the same time, if we look at the liquidity of the covered bond market, for instance, after the crisis, there have been studies that show that covered bonds have been, if not less liquid, at least comparably liquid to RMBS in the post-GFC period. So are we sure that by focusing more on covered bonds, we are solving this liquidity problem? And my final question, although I don't have an answer to it, would be, if we say that it's not through securitization that we achieve the goals of the CMU, maybe then it's the goals themselves that are not appropriate, or should we find a different way of, quote unquote, debanking the European economy? I'm not sure what your opinion is, but I would like to hear your comments. Thank you very much.
Great. So a couple of points. I think one, I kind of made it in my presentation already, but so I agree with you, Thomas, that securitization is very wide across the board, and you have so many different transactions. But even if we take the simplest securitization, the fact that it is an off-balance sheet structure, and it offers the originator capital and arbitrage relief, you know, it creates a fundamental different purpose than a covered bond that remains on balance sheet. I understand that there are wider industry implications there, because banks function in different ways across jurisdictions. So some banks may prefer the covered bond industry to flourish. Other banks may prefer the securitization industry to flourish. I would also add on this, let's look at the effect of the securitization industry in specific jurisdictions in properly housing bubbles. And I live in a city where there's a massive housing bubble that is going up. Yeah. So the question of capital relief that securitization elicits is right. It's not necessarily a question of complexity, but it's a question of transactional structure. So I still defend the fact that we need two different approaches there. There's a wider, higher level comment I would want to make. That's the question of economic recovery that you touched upon, and then I mentioned in the early slides of my paper. The idea that I think, first of all, creating harmonized capital markets for Europe makes complete sense. Now, what segments of capital markets we center that capital markets union on is a question mark. And I think it's fairly clear that the Commission's choice was to focus on that capital market, because there is much more focus and emphasis on the debt segments of European capital markets than on equity or other instruments. The literature is where I do disagree here, is we don't need to debank Europe. And there is clear literature on that actually successful European economies are those with many local banks. So we certainly don't need a situation like the US, where you've got fewer very large banks that don't essentially compete because we do the same, because they all do the same things. There is a lot of literature with data coming from IMF, World Bank, and Northern European central banks, suggesting that effectively SMEs and entrepreneurship as a whole flourish when they are accompanied, when they are supported by local banks. So effectively moving all this onto capital markets, I think is quite almost dystopian. Okay, it will work, it hasn't been working, and I don't think it can work. So we do need capital markets. We do need to develop capital markets as an alternative to banks, but we don't need to depend. And I am not convinced that the economic recovery in Europe goes through this capital markets union. I think there is no evidence suggesting, there's no data, there's no agreement suggesting that. So that's my higher level, wider point.
Yeah. Okay, thank you. In order to pay also a bit attention to a few comments, we can't, I'm afraid, deal with all of them. But I just wanted to refer to that Jan-Peter Hilbert basically clearly said, okay, the big difference, and there is also evidence, and I agree to that, that is also the reason why ECB, Bank of England, started the discussion in 2014, and later, as you rightfully commented on that there is evidence that basically the way US securitizations were structured with poor quality assets, high leverage, basically was not the case for Europe. So that basically that strict regime introduced in 2009 for European securitization was, in hindsight, perhaps not justified. The other comment of Jan-Peter Hilbert basically was the point that he basically suggests that the lack of the STS market basically kicking in, so basically being successful, is also related to the lower or the disappointing, if you like, effects from capital relief in view of the current rules contained in CRR. I think the same could be said for the Solvency II regulation as a noted point. And then his further comment was about had systemic risk at the gilt crisis in the UK in September 2022. He's pointing out that RMBS positions were basically used as a better suitable form of liquidity than covered bonds at that point in time. We got also a comment from George Dupont-Chile, and he basically mentions that Vincenzo objects to non-regulated assets such as P2P loans entering into capital markets as a layer of via the securitization technique. And he basically asked the question, why should the entire European securitization backed mainly by underlying assets that are originated by banks and already regulated prior to being tranched be punished via capital charges and liquidity criteria that cannot be justified based on assessments of risks? And the last question was from Nicoletta Mascher. And I was wondering why, in comparing securitization covered bonds, the argument about double recourse protection was not used. In asset allocation policies of institutional investors, this makes a difference. So the double recourse mechanisms of covered bond transactions, even when securitization may have a higher rating. So I think the latter comment might be a suitable one for comment by Thomas, but the former, perhaps Vincenzo, you can say a number of words about the capital relief as is currently in place, even for STS securitizations. And the second point on the differences in liquidity during the gilt crisis of securitization positions and covered bonds. Vincenzo, would you be so kind to first comment on these 2 points, and then Thomas, as a conclusion, the differences between covered bonds and securitizations and the double recourse mechanism. And then I think we have appropriately addressed the questions of the audience. Vincenzo?
Sorry, Bart, you want me to take which points?
There are 2 points basically which I think would be worthwhile to comment. That is first, the disappointing, if you like, capital relief for even for STS securitizations pursuant to the current CRR regime and the Solvency II regime, I would suggest. And the other one is the point of securitization positions being providing better liquidity profile than covered bonds during the gilt crisis in the UK. So these 2 questions, maybe you could give some reflection on that.
Right. Okay. So starting with the LDI, I've written on that. I don't see the LDI as, I think the LDI was a fundamental misuse of derivatives, just like in many other areas, just like pre-crisis securitization. Fundamental misuse of derivatives, creating synthetic position on certain assets. Worst case scenario materializes, which hadn't been modeled, of course, because models don't predict everything, and levels of leverage that hadn't been predicted in terms of the disastrous effect they could have. So that's how I read the LDI crisis. I think that's the main problem that were faced by the LDI during the LDI crisis. And again, a bigger crash was averted by prompt central Bank of England intervention. On the question of the STS, I see the comment here. Let me take a wider angle on that. The question I think we have to ask ourselves is, and I saw another comment on the criteria for the liquidity coverage ratio. I think I can agree on that. I can agree that the abundance of criteria, even the Basel criteria, is limited in itself. Problem is this: if you look at the genesis of securitization from the 1980s in the US, securitization was essentially engineered to help the three banks, the three institutions in the US, originate mortgages at a time when there was a massive application of home purchases in the US, and the three institutions didn't have a balance sheet that was big enough to sustain that demand. The result of that, the result of securitization, the result of the growth of securitization at that time meant that Wall Street cannibalized, the Wall Street banks essentially cannibalized three institutions. Now, I don't have an answer to, what is the right measure of regulation? What is the right measure of complexity? I agree that some of these criteria essentially mean we won't have regulation, we won't have securitization, because it's fairly impossible to, they are far too complex. The essence is, I still justify the punitive approach to securitization, because the problem I see today is we have to ask our question: why banks need to securitize so many assets? I go back to the wider problem, to the higher level problem. More debt in the financial system, more debt capital markets is not the answer to the socioeconomic problems we have. Securitization won't answer those macroeconomic problems. If anything, it will disguise them. It will create more risks, just like the LDI crisis shows. So I will, for the sake of brevity, I will conclude with that comment.
Okay, thank you very much, Vincenzo. And maybe, Thomas, you could end the discussion with, give some comments on the question raised by Tamasher. There are further questions. I've seen that, dear participants, but we need to start working towards closure of this discussion. But this particular question, indeed, covered bond structures, double recourse features are fundamental for institutional investors, and that's basically what is argued here, as compared to securitization transactions which do not contain these features, and this, if you like, credit enhancement of those positions. Could you give a brief reflection on that?
Yes, thank you very much. And thank you, Nicolette and Asha, for that question, because it is fundamental, and yet we didn't touch upon it during our presentation. Sometimes the most obvious things, we tend to forget them. Although I would argue that even taking into account the double recourse protection that covered bonds deploy, and what do we mean when we say double recourse? We mean simply the fact that covered bonds are first and foremost a direct obligation of the issuing bank, right? And it is only if the issuing bank defaults on its obligations that covered bond investors have recourse on the underlying cover pool of assets. That's what makes the recourse double, first to the issuing bank and then to the cover pool, compared to a securitization transaction where the issuing bank, or the originating bank rather, is out of the equation and you go straight to the cover pool. I can see very clearly why the credit protection that a cover bond offers might seem much more robust than the credit protection offered by a securitization transaction. My point is, if we compare things that are actually comparable, and in my view, that would be comparing true sale RMBS and mortgage covered bonds, the difference is not that big. Yes, we do have that double recourse, but if we look at the losses, the credit losses that investors have suffered so far as prime RMBS in Europe is concerned, during the GFC and onwards, they are practically zero, just like losses for covered bonds. And not only that, but RMBS in Europe suffered zero losses without any support by the European regulator, by the ECB, by the national governments. Far from it, from 2007 onwards, securitization was considered toxic. So nobody was willing to help in that concern. Covered bonds also suffered no losses, but the amount of help they received during the crisis was tremendous. We're talking about the asset purchase programs of the ECB that were introduced first for covered bonds, and then for anything else, we're talking about bailouts of banks in Germany, in France, in other places. So zero credit losses for both instruments, one with major support, the other without any support. And yet the regulatory treatment of covered bonds is preferential to senior tranches of prime RMBS. That's my point, that I don't see why this is justified, taking into account what I just mentioned. I hope that answers the question.
More certainly. So thank you very much for that. I had scribbled down also a number of questions because we haven't had we didn't have the time basically to discuss due diligence obligations as a response to the problem and the syndrome of automatic reliance on credit ratings as one of the reasons and backgrounds for due diligence obligations. The other one being questions with respect to the disclosures by banks. Admittedly, covered bonds basically do require less transparency requirements, but I would say to a little bit against leaning a bit to that argument, banks as issuers do have quite far-reaching disclosure requirements and transparency requirements. I would say even beyond what is necessary for securitization SPV. And for Vincenzo, I scribbled down some thoughts with respect to the plea of the Autorité Marché Financier to also have a sort of contractual standardization throughout Europe. And I was just wondering how that would work given, let's say, the differences in the jurisdictions in Europe, particularly civil law and corporate law differences. So that would have been an interesting point to be discussed. Also looking at the kind of cold shoulder that EBA, EIOPA, and ESMA gave to the industry that has been pleading for more lenient rules. And the three ASAs basically suggested to the Commission that there was no need for further flexibility apart from a couple of the points that you suggested. But other than that, there's not much more than that. So we could speak for hours about this topic, and I'm so very grateful for the introductions of Thomas and Vincenzo, the debate, the questions raised by the various participants. Unfortunately, we were not able basically to address all of them, and the chat function has been filled with many of them. We will save these questions and submit them to Thomas and Vincenzo, maybe for further reflection offline, and that would make a whole lot of sense. Christos just gives us his best regards, and I wanted to wholeheartedly thank all of you basically for this very interesting academic debate. Hope to see most of all of you back at further debates organized by the European Banking Institute. Thank you very much and have a good day for the remaining day. Thank you so much.